With the rising of interest rate, which interest rate should you be choosing? In today's video, I will be diving in depth to share with you whether you should be looking at a fixed rate or a floating rate at this current moment. My name is Kenneth from KeyQuest Mortgage. Let me share with you what interest rate you should be looking at today's market. If you watch towards the end of the video, you will know how to avoid the pitfall most homeowners are making in today's market. So the two common interest rate we are using in today's market is either you choose a fixed rate or you choose a floating package. And what is the main difference for these two packages? Let me just share with you. For fixed rate at the start of the year, in January to February, we saw that the fixed rate was actually only about 1% to about 1.3%, which today we are in the month of March. We are seeing all the banks are increasing their 2 years fixed to 1.6 to 1.65. What actually causes the banks to actually increase the fixed rate? And for floating package, over the last few months, we saw that the floating package has been quite stable. The bank spread was at about 0.5 to 0.6, and 3-month SORA has a gradual increment. At the start of the year, we are looking at about 0.24%. At today in March, we are looking at about 0.3%. So over the last 3 months, we can saw that there was a gradual increment from 0.24 to 0.3, that is a 0.6%. So if we average out, it's a 0.02% increment every month over the last few months. So for a floating package, a lot of customers always ask us, Kenneth, can the bank actually adjust the bank spread within the lock-in period, or the fluctuating component is only on the SORA basing on the market movement, which a lot of customers didn't know. The true fact is that the banks actually has the right to adjust the bank spread of let's say if your bank spread is 0.4, 0.5, 0.6, the banks has the right to adjust as long as you are a floating package or if you are taking a floating package. But what we see over the last few years, we did see an incident of a foreign bank which they tried to adjust the bank spread, because back in start of COVID in 2020, one of the foreign banks which was offering 0.15% plus SIBOR, and at that point of time, okay, they wanted to adjust because SIBOR dropped to an all-time low of 0.4%. So technically, for customers who took floating package towards 2019 or start of 2020, they actually are paying less than 0.6% in terms of their interest rate. And that's where the banks think that they want to adjust the spread. To cut short of what happened back then is that in the end, the banks did not manage to adjust the bank spread, because there was a lot of consumer feedbacking that is unfair. They weren't aware of all this spread is able to adjust. They thought that only the floating package. But the hard truth is that the banks has the right to that. The banks has the right to do it. But most likely what we see after this incident is that the banks wouldn't want to take any big adjustment and adjusting your bank spread that will actually cause a lot of unnecessary feedback from the markets. So this is one thing you probably need to know if you are taking a floating. So in conclusion, we will say the banks has the right to adjust your bank spread, but chances for them to adjust, it is very low. And we have an incident that happened in start of 2020. So we have covered the bank spread. Next is the SORA. So in today's market, there is 1 month SORA as well as 3 month SORA. What is the difference between a 1 month or a 3 month SORA? Basically, a 1 month SORA, it means that every month the SORA will change, okay? Whereby if you versus a 3 month, technically 3 month SORA will only change every 3 months. That means if the banks if there's a movement in terms of SORA, if you are on a 1 month SORA, every month it will change. Whereby if you are on 3 month SORA, 1 year, the SORA will actually fluctuate only for 4 times a year. And usually for the 1 month SORA, it is slightly lower compared to a 3 month SORA, because technically if they are taking a 3 month SORA, technically, in a way, I can say that you're getting a 3 months fixed rate. Why? Because the SORA will not change within the 3 months, and usually what we see over the past trend is that the 3 month SORA will be slightly higher. But what I want to share to you today, in today's market, the 1 month and 3 month SORA is actually at the same at 0.3%. So what does it tell you is that if you go for a 3 month SORA now, you are at a better off. Why? Because the 3 month SORA is the same as the 1 month SORA, and technically it's more stable, because if there's movement for 1 month SORA, maybe next month your interest rate might change, whereas the 3 months later, the next change will happen 4 months later down the road. So this is one of the main difference between a 1 month or a 3 month SORA package. So currently for the spread most banks are placing their SORA is the bank spread is about 0.55 plus a 1 or 3 month SORA, which is about 0.3. At this point in time, it's at about 0.8. But of course, the SORA might change, so you can always Google online to see what's the latest 1 month or 3 month SORA. Instead of Googling the latest updates on the latest 1 month SORA or 3 month SORA, or if you always want to be updated, what is the lowest interest rate in today's market? Okay, we will leave our business contact number below. You can actually drop us a WhatsApp and we will send you the interest rate update as and when there's a movement from the banks. On the other hand, on fixed rate packages, at the start of the year, it's about 1.2, or even at lowest we saw was about 1. And in today's market, it's at actually 1.6%. What actually causes the banks to increase the fixed rate? One of the reasons is because the cost of funds from banks has increased as well. So therefore, in order to match up to the bank's cost of funds when they're lending out, they need to actually increase the fixed rate. So this is one reason. Another reason what we look at the current situation is that because we have been enjoying a very low interest rate over the last 2 years, as a result, because of the cost of fund has increased for the banks, therefore the banks are also increasing the fixed rate. What we saw at the current trend is on a upward trend from a 1% or 1.1% to now we are looking at 1.6 or 1.7. And on 22nd March, there was a news from Business Time which they mentioned that SORA package might potentially hit 1% by end of December. But again, this also depends on the market movement. These are also from professionals from the industry which they analyze how the movement will be. So what we saw the trend is when SORA packages increases, like the 1 month or 3 month SORA, the fixed rate will actually go in tandem. They will actually move up concurrently. So over last year, when we look at the interest rate, the gap between a floating and a fixed, maybe the difference in terms of interest is 0.1, 0.2%. But in today's market, the gap has been widened. For a floating package now is maybe at 0.85, whereas a fixed is 1.6. So now, if you are going with a fixed rate, yes, it's definitely safe. Within the lock-in period, there won't be any fluctuation and you are paying a bit more premium for the fixed. Last year, the interest rate for a fixed and a floating, right, the package are actually quite close. That means maybe a floating was about 0.7, 0.8, the fixed was maybe 1%. The gap is only 0.2 to 0.3% difference. So a lot of clients will prefer, oh, why not I go for a fixed rate, because the differences is not huge. And in the event that floating does have fluctuation, it might cross the fixed rate. But in today's market, the floating is at 0.85, whereas the fixed is at about 1.65. Okay, we can see a difference of 0.8. So therefore, maybe floating can be an option to consider now. Still an option for you to consider. Why? Because you have a gap of 0.8%. But of course, if you are going for floating, you must be prepared that there is a possibility that if SORA package does shoot up to 1% versus your spread now maybe is at 0.55, it's 1.55 by end of the year. you are still a bit better off if you secure for a fixed rate. So that's why you might want to consider a floating package if you have a certain risk appetite which you can get, whereby if SORA does increase to 1% and your bank spread is 0.55, it's 1.55 and it's still slightly lower, and the increment should be gradual increment for the floating package. So that's why we won't cross out the options for you to consider a floating package as well. So now you have understand some of the difference between fixed or floating. But what other things you must be aware of between the difference between these two packages? So let's talk about some features. Why some customers opt in for a floating package? Because for floating package, they do have some clauses which the fixed do not have. Example, for a floating package, it actually allows you to make a partial repayment up to 50%. Second feature, some of the bank's floating package, the lock-in is only 1 year. So this is an advantage. Why? Because in the event that SORA has been increasing, it hits more than, it has crossed more than what the fixed rate is, you can always consider to switch from a floating package to a fixed rate package 1 year down the road. Another tips I want to share with you why some customers prefer a floating and with a 1 year lock-in. Because after 1 year, they can choose to refinance and stretch the loan tenor up to age 75 years old. And that means that, imagine you're 40 years old, instead of a 20 years loan tenor, you technically can stretch up to a 30 years. So for some of you, it makes a difference in terms of your monthly installment, because maybe if your loan is 2-3 million and you're paying, example, 7,000-8,000, by stretching for another 10 years, your installments will reduce 2 to 3K a month. So that makes a difference. So this is why some of clients actually consider to choose for a floating package because of these features. Number one features is that it allows you to make partial repayment within a lock-in period up to 50%. So if you have some funds coming in, maybe a floating package will be better. Second point is that you can actually extend or stretch your loan tenor to a longer period. Therefore, your monthly installment will reduce. So these are some of the advantage. For me, I look at fixed rate. You are paying a premium, and it's like buying an insurance. You actually pay a bit more for your interest rate to make sure that you are safe within the 2 years. But not forgetting, after the 2 years, you will be still on a floating package as well. So after watching this video, if you are still confused or you are unclear on which package to choose, either a fixed or a floating, feel free to reach out to one of my colleagues. They will be able to have a Zoom session with you to explain or to give you more clarity in terms of the package you want to go for, whether for your situation, is it better to go for a fixed or is it better to go for a floating? Because over the last 12 years, we have helped a lot of homeowners to make the right decision in terms of their home loans and to craft out an interest rate package which is suitable for them. Over at KeyQuest Mortgage, we work with 19 over banks in Singapore as well as financial institutions so that we can make sure at the point of time when you are applying for your loan, you are always getting the best interest rate, and we are also making sure that your interest is being taken care of.